The acquisition of First Data by KKR in 2006 was an important transaction not only for the massive size compared to previous deals, but for what it would mean for the deals that would follow it. First Data became a company primed for takeover as its profit margins thinned due to high expenses and a complicated, fragmented structure. The company grew to its current size and developed its structure primarily through acquisitions. The company known today as First Data Corp was actually the result of a merger between two of the largest financial services and data providers in 1995, First Data Resources and First Financial Management. These two firms encountered each other as competitors in a bid for the takeover of Western Union in 1994. And while First Financial won the bid for Western Union, the very next year, First Data and First Financial merged in order to remain competitive in an increasingly concentrated industry. The newly formed First Data Corp was quick to enter not only new geographic markets, but the growing internet transaction business as well, through continuous acquisitions and strategic partnerships. The revenues earned from a global presence were offset by inefficiencies that resulted from its rapid growth via acquisitions and partnerships rather than steady organic growth. First Data Corp's unwieldy structure led to a slowing in its equipment and technology advancements and a loss in market share as competitors like Total Systems Services passed them up to win over key clients such as Chase Bank. The company was also ill-prepared to expand into new and lucrative markets such as mobile payment systems. But stable cash flows and potential for profit through expense reduction made First Data Corp a natural choice for a private equity firm such as KKR. First Data Corp's shrinking profits led analyst Wayne Johnson of Raymond James & Associates to state the following about the pending deal. The company could be a higher margin business, and they're buying at a time when it's low margin. 3 to 5 years is a pretty good time frame to monetize this investment.
A closer look at First Data Corp's financials in the years leading up to its buyout give insight into why KKR found it to be an attractive target. In 2006, First Data experienced 8% growth in revenues, while cost of services was a relatively low 7%, leading to an operating profit of 22%. The key figure underlying the potential for improvement was FTC's net income loss of 12%. KKR was not breaking new ground in taking a credit card processing company private. Several of First Data's competitors had already taken advantage of the attractive market conditions and exited the public markets. Shareholders stood to gain early on thanks to a 26.4% acquisition premium over the current $26 share price. The investment banks involved were poised to earn significant fee income, primarily owing to the sheer size of the deal. Finally, FTC would benefit by consolidating their expansive operations under unified leadership. KKR believed FTC was a prime candidate for an LBO because their expenses could be reduced by getting rid of redundancies, mainly the 34 distinct end-to-end processing systems and 16 different command centers. Eric Grover, principal of Intrepid Ventures, said of First Data Corp, "I think it would be fair to say that the organization was marbled with redundancies." To lead the operation, KKR brought in Michael Capellas, who previously worked at MCI Incorporated and PC maker Compaq Computer Corp. Citigroup and Credit Suisse led the $29 billion LBO, raising a total of $22 billion in debt, plus $7 billion in equity from KKR. The debt consisted of $8 billion in BB+ rated junk bonds that contained a feature called the PIK toggle, which allowed First Data to repay bondholders with either cash or additional bonds, and $14 billion in a covenant-light senior debt, which meant that First Data was not obligated to update creditors on its financial status unless it was seeking more debt. First Data Corp's debt increased approximately 11 times from $2.3 billion in 2006 to $22.5 billion in 2007. Bob Lee, VP at KDP Investment Advisors, said First Data Corp's leverage ratio of 8.8 times EBITDA was unusually high, with most LBO deals at 5 to 6 times EBITDA. The banks involved in the First Data LBO committed to KKR before the credit turmoil in July and August at a 500 basis point premium to LIBOR, an equivalent interest rate of around 10.75%. The ensuing drop in demand for risky debt meant that First Data loans had to be sold at 94 cents on the dollar, leaving the banks with a loss of between 3 and 4 cents on the dollar. On a $14 billion loan deal, that translates to a loss of $420 million to $560 million. Citigroup, the lead underwriter, was heavily involved in risky deals, being the lead underwriter on 5 of the 6 largest leveraged loans at the time, with an approximate value of more than $70 billion. Citigroup was also the lead underwriter on 3 of the 5 pending high-yield bond deals, with more than $20 billion. Analysts at JP Morgan said, "It is disappointing to see Citi well above peers in pending deals."
In August of 2007, trouble began for the transaction. With the onset of the credit crisis, the market suddenly turned sour to the deal. Demand waned for speculative debt as concerns over the stability of the subprime housing market began to mount, and the unique features of the debt being offered further complicated the deal. What's more, analysts predicted that the debt burden would leave First Data with just enough cash flow to make interest payments and capex. The negative sentiment towards the debt in the First Data transaction left banks underwriting the transaction with two options: either cancel the deal and pay $700 million in penalty fees and potentially lose the ability to work with KKR again, or assume the entire $22 billion in debt and the risk of a drop in price. The markets were watching this deal closely as it would set a precedent for the upcoming $330 billion in LBO transactions to be completed by the end of the year. Bradley Kane, a portfolio manager at SCM Advisors, called the transaction a bellwether for the pending LBO deals, saying that it will draw a line in the sand for companies with similar ratings and structural fundamentals. Bob Lee of KDP Investment Advisors agreed that the First Data transaction was very important for the other deals, noting that the loss the banks end up with plays a large part. So with all this negative sentiment regarding the PIK toggles and covenant-light loans and the future cash flows of the company, what pushed the deal through? On September 11th, the Wall Street Journal reported that over the weekend, KKR agreed to add one key covenant to the First Data debt. The company agreed to maintain a certain ratio of EBITDA to senior debt. Market conditions improved as rate cuts by the Fed prompted debt investors to seek higher yields, and the banks were finally able to move the senior debt. Finally, the buyout was executed on September 24, 2007. Each issued and outstanding share of common stock of the company was canceled and converted into the right to receive $34 in cash without interest.
Currently, First Data continues to be straddled with more than $22 billion in debt, almost 11 times the amount on its balance sheet before the LBO. The analyst prediction of First Data's cash flow barely covering the $2 billion in annual debt service payments and capex proved to be correct, as the company has made no headway towards principal reduction of its outstanding debt. Since the buyout, First Data has gone from earning billions in yearly profits to suffering losses ranging from hundreds of millions to billions of dollars. The changes made in an attempt to reduce expenses have transformed the company as a whole. A 10% reduction in workforce globally reduced employees worldwide from 27,000 to 24,000. The firm also cut operations in 3 countries and shed fringe joint ventures in order to focus on core sales operations and spur organic growth by increasing merchant locations. Before the LBO, First Data bought its way into many foreign markets, but has been noticeably less aggressive in expanding their footprint overseas since 2007. The new management further consolidated a bulk of data processing and command centers into 3 locations. First Data's interest expense skyrocketed after the KKR LBO, from interest payments of $250 million on $2.5 billion in outstanding debt to $1.8 billion in interest payments on $22.5 billion in outstanding debt. First Data's revenues have increased slowly since the LBO. The EBITDA and net income have lagged behind, even dropping below zero a few years. Another performance metric, return on assets, reveals how First Data continues to be outperformed by competition. Fidelity Information Services consistently outdoes First Data, indicating a more efficient use of assets.
First Data selected a new CEO earlier this year, Frank Bisignano. Soon after being brought on, he laid out his strategy to have a capital structure change. In October of this year, First Data Corp received a $300 million cash investment and issued an additional $1.4 billion in senior debt to retire PIK bonds coming due in 2016, essentially deferring the liability until 2019. The First Data Corp LBO has not turned out well for KKR. The company was recently valued at only 70% of KKR's initial investment. We believe the CEO himself captured both the uncertainty of First Data Corp's financial future and the need for a transformation with this statement. Over time, there's going to be a capital structure change. We will talk about that in the future. If that's an initial public offering, that's what we'll do. What we are working on today is getting the company to perform as it has in the past, continue to work on it, and the rest will take care of itself.